A lot of Americans think their house is their backup plan. But in 2026, tapping your home equity could be the exact move that keeps you broke. If you locked in a 3% mortgage and refinance into today's rates, you may be lighting 6 figures on fire without realizing it. That sounds dramatic? It's not. Mortgage rates that lived near 3% in 2020 and 2021 are now sitting closer to 6.5 to 7% for many borrowers in 2026, depending on credit and loan structure. And when you do a cash-out refinance, you are not just borrowing money. You're replacing cheap debt with expensive debt on the largest asset most families own. That's the part people miss. Most people hear home equity and think safety, flexibility, breathing room. I get why. Rent is insane. Groceries still feel disrespectful. Insurance costs are up, and a lot of people are staring at credit card APRs north of 24%. When life punches you in the face, your house looks like the only place with money left in it. And honestly, the system trained you to think that way. Banks market home equity like it's responsible. Softer language. Lower rate than a credit card. Friendly ad copy. Use your home to fund renovations, consolidate debt, or cover big expenses. Sounds smart. Sounds adult. Sounds like a plan. Sometimes it is. In 2026, for millions of homeowners, it absolutely is not. Sarcastic. Because if you grabbed a 30-year fixed mortgage at 2.75% or 3.125%, you are holding one of the best financial assets of the last decade. Not because your house is magical, because your loan is. You don't casually throw away cheap fixed-rate debt in a high-rate world. That's like trading a locked-in gym membership for a luxury trainer you can't afford. Stick with me, because the next number is going to make you angry. Let's say you owe $300,000 on a mortgage at 3% with 25 years left. Principal and interest is roughly $1,423 a month. Now imagine you do a cash-out refinance into a new $380,000 loan at 7% for 30 years so you can pull out $80,000. Your new principal and interest payment jumps to about $2,528 a month. That's over $1,100 more every month. Not for a vacation mansion, not for private school, just to access equity you already had. Over time, that decision can cost well over $100,000 in extra interest, and in many cases, much more, depending on how long you keep the loan. The Federal Reserve's rate cycle changed the math. The old advice stayed the same. That's why people are getting cooked. I watched a family friend do this after 2021. They had a beautiful low-rate mortgage. Then came remodeling, some credit card cleanup, and one temporary cash squeeze. The refinance felt clean. One payment, more room, less stress. For about 4 months. Then the new payment became the stress. The old problem didn't disappear. It just got welded to the house. So what is cash-out refinancing really? Quick definition. You replace your current mortgage with a bigger one, and the difference comes back to you in cash. That's the what. The how is where it gets dangerous. Because in 2026, you're often swapping a legacy low-rate mortgage for a brand new high-rate mortgage, resetting the clock, paying closing costs, and increasing total interest at the same time. And here's where the math gets uncomfortable. According to Freddie Mac, the average 30-year fixed mortgage rate was under 3.1% in parts of 2021. In contrast, 2026 borrowers are dealing with rates roughly double that. The CFPB has repeatedly warned that homeowners using home equity for debt consolidation can reduce short-term interest costs while increasing long-term housing risk. Translation, your credit card debt was ugly. But now, your shelter is collateral too. That is the thesis of this whole video. In a high-rate market, cash-out refinancing doesn't just give you access to money. It can quietly convert home equity, your strongest balance sheet cushion, into a wealth leak that compounds against you for decades. Let's break the myth. The poor way to think about home equity is, I have $200,000 in equity, so I can use some of it. The rich way to think about it is, what is the cost of disturbing the financing attached to this asset? Huge difference. One mindset sees available cash. The other sees opportunity cost. If your mortgage is 3%, that debt is cheap by 2026 standards. If inflation runs near 3% and high-yield savings accounts are paying around 4 to 5% APY depending on the institution, your fixed mortgage is not the emergency. It may actually be one of the best liabilities you have. Weird sentence. True sentence. Banks know most people don't compare the old loan to the new loan the right way. They compare the cash received to their current pain. That's emotional math. Emotional math is how people stay broke. Take another example. A homeowner has a $250,000 balance at 2.9%. They need $60,000 for debt payoff and repairs. They refinance into $310,000 at 6.875%. Payment rises hundreds per month. Plus closing costs maybe run 2 to 5% of the loan. On top of that, they restart a 30-year amortization schedule, meaning early payments go heavily toward interest again. That one move can erase years of progress. This is why I keep saying your house is not an ATM. Not because tapping equity is morally wrong, because the timing matters, the rate matters, the reason matters, the alternative matters. I used to think consolidating expensive debt into a mortgage was automatically smart. Lower rate, right? Cleaner payment, right? Then I ran the full amortization tables. That was the moment it clicked. A lower rate on paper can still be a worse wealth decision if you reset term length, increase balance, and put unsecured stupidity onto secured housing. That is not optimization. That's moving the mess into a more dangerous room. So why are homeowners still doing it? Because the pain is real. BLS inflation data may cool on headlines, but insurance, property taxes, utilities, and maintenance don't care about your headline. Wages have not made life feel easy, and a lot of households are asset rich and cash poor. They have equity trapped in drywall, while their checking account looks like a hostage note. That doesn't mean every equity tap is dumb. It means lazy advice is dumb. But that's just the surface. What they don't show you is the balance sheet damage. When you cash out, 3 things can hit at once. First, your monthly payment rises. Second, your home equity cushion shrinks. Third, your future flexibility gets worse. If home prices flatten or fall in your market, now you have less room to sell, move, or refinance again. If income drops, the bigger payment doesn't care. If you use the money on consumption instead of productive value, you borrowed against tomorrow to survive today. And let me be blunt. Using a 7% cash-out refi to pay off 24% credit card debt can still make sense in narrow cases, but only if the behavior that created the card debt is dead, buried, gone. If not, you don't solve the debt, you duplicate it. I've seen people wipe out cards with home equity, feel relief, then run the cards back up within a year. Now they have the mortgage and the cards. That's financial quicksand. Now, let me show you the twist most homeowners and even a lot of advisors miss. The real comparison in 2026 is often not cash-out refinance versus doing nothing. It's cash-out refinance versus a home equity line of credit, or HELOC, versus a home equity loan, versus a brutal 12-month spending reset while preserving the 3% first mortgage. That changes everything. A HELOC can still be risky. Rates may be variable. Payments can jump. But if the alternative is blowing up a first mortgage at 3%, A second lien product can be less destructive because it leaves the cheap first mortgage untouched. Same with a fixed home equity loan in some cases. Finish this. The most dangerous money move that sounds responsible is blank. Drop it in the comments. I want to see how many people have been sold the same polished nonsense. If this surprised you, someone in your life needs to hear it. The like helps them find it. This isn't about never using home equity. It's about refusing to destroy a strong balance sheet just to feel temporary relief. Your house should protect your future, not become the place where every bad financial decision gets hidden. And honestly, the real culprit isn't just your spending. It's a system that makes expensive borrowing feel normal, then calls you irresponsible when the math catches up. Still, once you see the math, you own the next move. Your future self is watching right now. Subscribe if you want to give them a better life. This channel is for people who want the honest math, not the comforting lie. Protect cheap debt, build liquidity on purpose, use home equity carefully, not emotionally. That's how you stop looking rich on paper and start getting rich for real.